Hey everyone, it's Anthony here with Financing Simplified. Thanks for clicking on this episode. We're going to be talking about the Bank of Canada. Are they done raising rates, or is there more room for the Bank of Canada to increase in September? Stay tuned, you don't want to miss it. Earlier this week, the Bank of Canada raised its policy rate by 0.25%, bringing the overnight lending rate to 5%. And obviously this will have an impact on many Canadians, whether you're in a variable rate mortgage or you have a secured or unsecured home equity line of credit or HELOC. Obviously, with the higher cost of borrowing, the prime lending rate going from 6.95% to 7.20%, this is a 22-year high, something we haven't seen in a very long time. And many Canadians are feeling the pressures of these higher interest rates. The question remains is whether or not the Bank of Canada is done raising rates in September, which is the next time they meet, or is this just the beginning of where the Bank of Canada will be headed when they resume their meetings in September for the rest of 2023. Obviously, there are many mixed emotions when it comes to what could happen next. And on this episode, I want to take an opportunity and go through some of the data points that the Bank of Canada, some other economists have released, and why I think that the Bank of Canada may be done in September. Let's take an opportunity to get to some of these actual data points. But before we do that, I want to invite all our viewers, if you're new to the channel, thanks for clicking. And if you're an existing viewer, make sure you're subscribed to the channel, as well as hit that notification bell so you get notified every time we post a new video. And do us a favor if you can, don't forget to like the video, share the video, and please leave a comment in the comments section below. Let us know your thoughts. And if you're subscribed to our In Touch Mortgages page on YouTube, we have introduced a new segment on Wednesdays. We are doing podcasts, so stay tuned for that every single week. We have launched our first one for this week. It is up and live on our YouTube channel. So let's get into some of these data points that the Bank of Canada is paying close attention to. As mentioned, the Bank of Canada increased its policy rate 0.25% on Wednesday. And in Canada, obviously, the inflation rate is measured by the Consumer Price Index. So why is this important? The CPI, as it is a major indicator for the Bank of Canada, it dropped significantly to 3.4% in May compared to the peak that we saw over the last year or last summer at 8.1%. So Bank of Canada paying close attention to that. This decline can be attributed to lower energy prices rather than underlying inflation, according to some economists. Now, this is excluding the price increases from the previous year or the base effect. There are less immediate pressures on inflation. The Bank of Canada paying very close attention to core inflation, not headline, but that rate has remained between about 3.5 to 4%, indicating an ongoing underlying price pressure there, and the Bank of Canada doesn't like that. So while the global inflation is easing due to lower energy prices across the board, strong demand and tighter labor markets are causing inflationary pressures in the service sector, and we'll talk about that and more in just a moment. But overall, the Canadian economy, according to the Bank of Canada, has shown better than expected performance with strong demand and a 5.8% growth in consumption during the first quarter of 2023. What will happen in the second quarter will obviously impact what the Bank of Canada may decide to do next. Now, despite expectations of further slowdown in consumer spending, there are signs of continued access demand and more spending from things like pent-up savings or those stimulus incentives that the government issued over the past few years. Obviously, that is sort of to play off right now. We're starting to see those savings diminish, although this is also having an impact on the housing market. And although supply is lagging, we're starting to see some of those numbers roll over, leading to higher prices. Although we're seeing some things in the housing market slow down for the month of June, the Bank of Canada continues to monitor all these trends. And one trend is that it continues to see higher interest rates playing its desired effect in the economy and in the market. And interest rates tend to be an on-off switch for the housing market, right? So obviously housing is a very important aspect for the Bank of Canada. We'll touch a little bit more about that in just a moment. But overall, the rebound in the job numbers in June and the relatively low unemployment rate compared to the pre-pandemic levels may have pushed the Bank of Canada and the Governing Council over the edge. and towards immediate rate hike of 0.25% on Wednesday, as they were uncertain about what they should be doing. And that was something that came on the press conference. Obviously, the Bank of Canada did decide to increase with the Governing Council 0.25% to tamp down on those inflation numbers and sort of keep us on course. Now, recent data does show that an increase in job numbers in Canada, their job numbers had increased. Around 60,000 new jobs were added in June. And that's the largest gain since January of 2023, resulting in a total increase of 110,000 compared to the previous months. However, this news was overshadowed by a rise in unemployment and a decrease in the labor pool. So obviously you have higher job numbers, but you have an increase in unemployment and less jobs in the pool. Despite Canada's population hitting that 40 million mark, the unemployment rate rose to about 5.4% from 5.2%. And this increase was accompanied by growth in the labor pool due to current immigration levels. So there's more, more people looking for jobs in the market as immigration levels increase. And yet, as the labor market in Canada indicates greater availability of these workers, more and more people are arriving, more people entering or trying to enter the workforce, conditions remain tight with wage growth ranging from 4 to 5%. So obviously, as we see that happening, more people earning means more people spending in the economy. And yes, that also includes on housing. It's where people get secure jobs, better wages, while they may consider purchasing or they may consider holding off. Obviously, this having an impact across the board, strong population growth overall, resulting in immigration boosting up the demand for supply in the economy. That sort of human quantitative easing, the more people you introduce into the economy, the more people are spending, and obviously that has an impact on housing. But economists at TD have observed a slowdown in unemployment trends, with a decreasing of around 3 to 6 months in those trends. So they're looking at 3 to 6 months. They expect that unemployment rate in Canada to reach 6% by the end of the year. So unemployment to hit 6%, that is obviously a big jump from 5.4, and where the Bank of Canada would be happy. That could mean that because of these decreases in vacant job positions, that could lead to relief in the labor market as businesses who face competition for work and talent. The decrease in those job vacancies can also, help alleviate the pressure on those wages, right? Bringing those wages, the wage spiral down, which play a crucial role in inflation and closely monitored by the Bank of Canada. So if we start to see those unemployment numbers tick up to 6%, according to TD, and less people in the workforce, that could be a very good positive sign for September. On a side note, it's important to obviously look at our neighbors to the south, and keeping in mind that the United States, their unemployment decreased from 3.7 to 3.6. And in June, accompanied by a significant job gains like we saw in Canada, the strong job market poses a challenge for the Federal Reserve in managing growth and inflation. This means that the Bank of Canada and the US Fed could be playing a cat and mouse game when it comes to their monetary policy rate. It's widely expected that the US Fed will raise rates in the near future and continue to, and also considering the relationship between Canada and the US, the economy, their trading partners, monetary policy being very similar, and obviously spending in the economy and stimulus spending, not to mention obviously what it could mean when it comes to the Canadian US dollar and trade, and whether or not those dollars are close together. Either we're importing inflation, from those purchasing of goods if our dollar drops. Obviously, that's important to understand for September. We'll see how things play out there. But looking globally, it's important to understand that economic growth has surpassed expectations, particularly in the United States. Although China's growth has slowed, the Bank of Canada predicts a slowdown in economic growth due to higher interest rates across the board. So not only in Canada and the US, but across the entire globe, where monetary policy and central banks are tightening, if they continue to do so, with modest excess supply anticipated before growth picks up around 2025. That's where the Bank of Canada sees growth moderating, coming back to life. The CPI inflation is projected to stay around 3% in the near term, raising concerns about achieving this price stability. That's when they talk about sticky inflation, where things are headed. As we start to see the headline inflation come down, some of those core numbers might be a little bit more sticky. Obviously, time will tell, but more importantly, the Bank of Canada will closely assess various factors and data to determine their alignment with that inflation target of 2%, maintaining a commitment to restoring price stability through monetary policy measures. But although I do feel that the Bank of Canada is often driving blind and using a lot of lagging indicators, I think the Bank of Canada, in their dovish sentiment in the most recent press release, hopefully has some relief. Overall, it's clear that inflation has been declining, especially when excluding food prices. By excluding certain things from that metrics, the impact, especially like the impact on mortgage interest costs, as we've seen, inflation is further reduced from 3.4 to 2.5 if we remove mortgage interest costs. These delayed effects on previous interest rate hikes by the central bank could still influence the economy as inflation approaches that 2% target. They're keeping an eye on that as it enters that range. Obviously predicted to get there by the end of the summer, 3%, but things are very, waffling between what's happening with real interest rates, negative interest rates, because right now inflation, 3.4%, but the cost of borrowing for most products is well over that. So that could obviously have a big dynamic shift on Canadians and their spending, and we're starting to sort of see that happening with home sales and listings. All that we'll talk about and more in a future episode, so make sure you're subscribed. But one thing to consider is with more Canadians feeling the financial pressures from the higher interest rates, and according to recent surveys that found that some Canadians are around $200 away from not being able to meet their financial obligations, and seeing that insolvency amongst many Canadians and for millennials is starting to increase, the cracks are forming, right? What the banks are starting to do, increasing financial pressures has been observed by the Bank of Canada, other institutions or regulatory bodies when it comes to households and mortgage renewals that are going to be happening in the next little while at higher interest rates, how that's going to play out with payment shocks, the rise in concerns of maybe reckless lending practices over the last little while. Regulation expect financial institutions to sort of establish new procedures for identifying and assisting mortgage borrowers that are at risk. So obviously, in a nutshell, what we're starting to see is things are starting to change with how the government and other bodies are starting to make these announcements. Just last week, recently, we received news from Chrystia Freeland and the Financial Consumer Agency of Canada, the FCAC. You may have saw her come on and talk about endorsing the needs for stricter guidelines. But basically, financial institutions or federally regulated financial institutions are now going to be required to specifically have procedures to identify mortgage borrowers who may be at risk. Those procedures could involve proactive measures to monitor and determine early signs of stress. Obviously, additionally, the federally regulated financial institutions, FRFIs, should have clear criteria in place on how they will be monitoring mortgages and those borrowers who need relief. So this is something that is still coming out. Remember, OSFI, Office of the Superintendent of Financial Institutions, regulates the banks, those federally regulated banks, and requires them to be financially solvent and responsible. But yet the FCAC is representing, the consumers and making sure that they are properly represented. And if there's some reckless nature or something that may have happened causing distress, how these two bodies will come together. And we'll talk a little bit more about that, but just in another episode. But briefly, what I do want to do is say that these actions by the FCAC may include things like waiving prepayment penalties, internal fees and cost. Obviously, these things are going to cost the bank money. So what is the trade? Lenders are also advised against charging interest on interest and are encouraged to consider extending the amortization period for affected borrowers. These guidelines aim to protect borrowers from undue financial hardships and promote responsible lending practices within the mortgage industry. Now, remember, as I said, the banks are going to have to trade something. They were just thrown these measures like they've done with the deferrals back in 2020. And, as we start to gather more details on this actual topic we'll provide further information definitely on this question for Canadians The bank, along with their legal teams, will have to define things that are in the FCAC, such as reasonable and fair. What is a fair amortization, or what is a reasonable amortization? And we'll definitely touch on this again in the future, so make sure you're subscribed to the channel. It is recommended that if you are in a financial situation where you need some help, to reach out to your financial institution to see if there's anything or any special accommodations they can make. But overall, as inflation diminishes, the lingering effect on the previous monetary policy tightening continues to impact the economy in many ways, as we see all these legislations, more and more scripting have to be put into place to protect Canadians. There is uncertainty regarding the need for further interest rate hikes. That is the big question. Do we need more, or is this it? Can the Bank of Canada sit back and pause? Will the Bank of Canada sit back and pause in September and really reassess the situation? Because obviously the situation for many Canadians who own homes, those who maybe rent, those who have a mortgage, obviously as these numbers start to come out, what does it mean for Canadians, everyday Canadians, because not everybody's in the same boat. Obviously, what will the impact be on Canadians? And fixed rate mortgages being one of them, as these Canadians, we touched upon it earlier, as these Canadians get to the renewal point, they may be renewing into end of 2023, early 2024 and onwards. As these bond prices continue to move, we'll be tracking that here on the channel. But obviously the fixed rate mortgages are going to be a big component as many Canadians begin the renewal process and that payment shock continues. So you have all these things to take into consideration: jobs, supply of jobs, in unemployment. You have basically growth. Where does the Bank of Canada see things headed? Are Canadians continuing to spend? Where are they getting this money from? What is happening in the credit system, insolvencies, defaults? All these things are basically on the Bank of Canada's table. They are looking at all these things in total. The Governing Council has access to all this data, but I believe personally that the Bank of Canada is pretty much done. I believe they've already increased their policy rate significantly higher than what was required of them to do. And obviously the Bank of Canada, historically, many central banks tend to over tighten and then have to aggressively pull back as we enter a recession, and they cataclysmically cause a major catastrophe in the economy and have to figure out a way to rebalance everything. But obviously, only time will tell, and that's my opinion. You don't have to share it, but I do want to share your comments in the comments section below. Let me know what you think the Bank of Canada will do next. Did they over-tighten? Did they under-tighten? Is there more room for the Bank of Canada to up its policy rate? Let us know in the comments sections below. But we'll leave the video here, wishing everyone a wonderful Friday and an even better weekend ahead. Thanks for clicking, and thanks for watching.